Learning Objective 2 introduces you to two tools that we use to analyze companies. Um, Horizontal analysis is a tool, and vertical analysis is a tool. Okay, so these two tools are the subject of Learning Objective 2. The third tool here, ratio analysis, that's listed is the focus of the next learning objective. So we'll get to that. The purpose of financial analysis is really to analyze the financial statements. So you spent the better part of a year learning about the financial statements in detail. And so now you're going to be using those financial statements and analyzing them with these tools. So the first thing, horizontal analysis, we also called it trend analysis because it evaluates data over time. We look for increases or decreases that have taken place over time. And we can use horizontal analysis on both the balance sheet and the income statement. And this is basically how it looks. This is a balance sheet for Chicago Cereal. It's a comparative balance sheet because here you have the numbers for 2014 in the first column and 2013 in the second column. The third column is where the analysis is done. And notice there's two parts to it. The first is the amount, the change from 2013 to 2014. So in this case, you see the current assets went from 2427 in 2013 up to 2717 in 2014. That's a difference of 290. So that's the amount. The difference between the two numbers is the amount. The percentage is the amount that it's changed divided by the base, which will be the number in the 2013 column. So 290 divided by the 2427 tells you that the change was 11.9%. So that's the change is positive. So the number here, this is a positive number indicating that it went up or to more. For property, plant, and equipment, we started with 2816. We ended with 2990. That's a difference of 174. 174 divided by the 2816 is 6.2% more. So we have 6.2% more plant assets from 2013 to 2014. Same thing for other assets as well as the total. So again, the amount is in the first column. The percentage is the amount divided by the number that was the base, which is that year that we started with. Okay, so that's how we get it. And we always do just one decimal on the percentage. So we're rounding to the 10th. Okay, we're not going past that. Same thing here for liabilities and stockholders' equity. We are looking for differences between the base year and the most recent year. So the difference here is very small, 24. 24 divided into the base of 4020 is 0.6, so it's less than 1%, 0.6% more. So it's a very small increase. And here you can see again, the difference in the dollars or amount is listed in the first column, percentage in the second column. I want to bring your attention to the treasury stock account here because it went from 912 up to 1357. So this is an increase of 445. 445 divided by 912 is this 48.8%. Now you have a negative divided by a negative, which is why the percent changes positive. Okay. So just wanted to point that out. So that's how we do it on the balance sheet. On the income statement, this is a comparative income statement for 2013 and 2014 here. And it's the same. We are looking for the difference between the base year and the most recent year. The amount is noted in the first column, which is simply the difference between those two numbers. And the percentage is listed in the second column. And again, that percentage is the amount of the change divided by the base year. Okay. So that's all the way true here. This is interesting though for your other. This can sometimes be confusing in this sense. You're going from a positive 13 to a negative 2. Okay. So that's 15 places to the left. So the change here is 15. 13 will bring it to 0. You need negative 2. So 15 places. So you have a negative divided by a positive. 15 divided by 13. And that will mean your answer will be negative, and it's over 100%. So it's 115.4%. And so that's basically, and it's negative because it went down from 13 to negative 2. Same thing here for income tax expense, went from 468 and it went down to 444. That's 24 less, right? So minus 20, negative 24 divided by a positive 468 gives you a negative percentage, 5.1. It's 5.1% lower than it was. So just to make sure you're understanding the positives and the negatives when it comes to both the amounts and the percentages. But this is horizontal analysis. Okay, one year to the other, amount, percentage. Vertical analysis is a technique that makes everything a percent of a base amount. It's called common size analysis, and we can apply it to both the balance sheet and the income statement, and we will. So this is what we mean by a base. We know that assets have a total. The total assets are the base. The total assets are 100% of the assets. When you look at the current assets, and you have 2014 numbers here, 2013 numbers here. Again, the base is, in this case, the total. So when you look at your current assets at 2717, what percentage of the current assets of the total assets? So it's 2717 divided by 11,397. Your current assets are 23.8% of your total assets. When you look at property, plant and equipment, 2990 divided by the total of 11,397, your property, plant and equipment are 26.2% of your total assets. Your other assets are 50%. So these three numbers will equal the total because each of these numbers equal the total. And again, we do the same thing for each year. The base is the total in this case. On the other side of the balance sheet, the total is total liabilities and stockholders' equity. That's the total. So this becomes the base. All the numbers are compared to the base to get the percentage. So current liabilities are 4,040 compared to a base of 11,397. Current liabilities are 35.5% of all liabilities and stockholders' equity. When it comes to long-term liabilities, 4,827 divided by a total of 11,397. Long-term liabilities are 42.4% of all liabilities and stockholders' equity. When you total your liabilities, it's 8871. 8871 over a total of 11,397 means that your total liabilities are 77.9% of your total liabilities in stockholders' equity. And that's what you're doing all the way down here. Notice treasury stock it reduces stockholders' equity. So it's going to be a negative 1357 over a positive. So anytime you do a negative by a positive, the answer is going to be a negative. And total liabilities, 77.9 plus total stockholders' equity of 22.1 is 100% of total liabilities in stockholders' equity. So this is vertical analysis with a balance sheet. And again, it's done for each of the years. Okay, but it's a percentage of the base. It gets more interesting, I think, with the income statement, because I do this for the college all the time. So here we have the base is your net sales, because think about it. It's from your net sales that all your expenses are subtracted, and your net profit comes from your net sales. So everything is a percentage of net sales. So net sales is your base. Okay. So from your net sales, you have cost of goods sold. So in this case, your cost of goods sold is 6,597 divided by a base of 11,776. So your cost of goods sold is 56% of the total net sales. Your gross profit is 5179. 5179 divided by 11,776 means your gross profit is 44% of your net sales. Okay, and all the way down, all the way to get to net income. We've already done gross profit divided by net sales. That's our gross profit margin. We've already done net income by net sales. That's our profit margin. We've already done that way back in chapter 5, I think. So this is just doing it for all the numbers that are on here. This number is so small, a -2, that when you divide it into a larger number, like 11,776, it's 0.00 something. So again, we're only rounding to the 10th. So this literally is 0.0. Same thing for 2013, where the total sales is your base. Everything else is a percentage of the base. Okay. And that's your vertical analysis. Vertical analysis is interesting because you can actually compare two companies with vertical analysis. Here we have a small company called Chicago Cereal, and all of their numbers are in the thousands, which means you add 3 zeros to that. With General Mills, which you probably have eaten a General Mills cereal at one point in time in your life. It's a huge company like Kellogg's and others. And their numbers are in millions. And so this is 17,910 million. Much bigger company than Chicago Cereal. However, when you use vertical analysis and you use the sales as your base, then you can start comparing how the companies are. So here, their cost of goods sold for Chicago Cereal is 56% of the sales dollar. But look at General Mills. Their cost of goods sold is 64% of every sales dollar. So they have a higher cost of goods sold. Chicago Cereal has a much better gross profit margin than General Mills does. Okay. But then here's where General Mills makes a difference. They're a very large corporation. Chicago Cereal is a smaller company. And so when you talk about selling and administrative expenses, they're only 19% of their total versus 28%. Again, smaller company, not as vast. You can't take advantage of economies of scale or be that efficient. So when it's all said and done, their net income is over 9 cents of every dollar versus over 10 cents of every dollar. So even though there's a lower gross profit margin for General Mills compared to Chicago Cereal, their efficiencies as being a very large corporation mean that they're able to squeeze out a bigger net profit out of their sales than Chicago. Although Chicago's not very far behind, it's really doing quite well for a small company. And that's how we would do horizontal analysis. So here is a little do it exercise, and you'll have homework on this as well. This is for a rose patch, which I'm sure Jennifer did not mow her rose patch, and flowers are everywhere because, she stuck to the lawn. She did a good job. Here we have their current assets. And I've never heard of plain assets. Maybe it's just plain old vanilla, but it's supposed to be plant without the I, I'm sure. So plant assets and their total assets for 2017 and 2016. Again, we are comparing a base to the most recent, noting the differences. So current assets were at 180. They're at 234, right? That's a difference of 54,000. 54,000 divided by the base of 180 meant that it increased by 30% in that period of time. Plain or peanut assets went from 420, which we just actually had 420 not too long ago. In fact, was 2 days ago. So we went from 420 and smoked all the way up to 756. That's a huge difference of 336. When you take that difference of 336 and put it back over 420, it burns up to 80%. Okay, so it's a big 80% return there, a difference rather. And your total assets went from 600 to 990. That's a 390 difference. Putting that back over 600 shows a 65% increase in total assets. So again, from 2016, that's your base, to 2017, your most recent year, is what you're calculating, both in the amount and in the percent increase. Okay. Fascinating. I know. Oh, wait, it gets better. Now we turn to ratio analysis. Dun, 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 dun. The good news about the ratio analysis is you've seen all these ratios because we've been doing ratios since chapter 2. Remember way back in chapter 2, we had in Accounting 101, we were introduced to ratio analysis with a few of them. And then this semester, right, from chapter 5 all the way on to even last chapter, we've had ratio analysis, more ratios, more ratios. So all of those ratios sort of are compiled here. So there's really no new ratios you're going to learn. It's all from the last year of study. So the first ratio they introduce you to, again, from way back in, like I said, chapter 2, price earnings ratio, which simply is whatever the price of the stock is on the market divided by its earnings per share. So that gives you the price earnings ratio. And it's basically what investors are willing to pay for every dollar. It's a multiple. How many more dollars are they willing to pay for the stock for every dollar of earnings or profits the company has per share? Normally speaking, if a PE ratio is on the higher side, you'll see this in this next slide. Most PE ratios are between 15 and 25. So here we have Apple and Southwest for whatever year this was. Their PE ratios were 16 and almost 20. So these were sort of in the normal range of most companies. But you look at Nike and Skechers, which looks a little sketchy, and Google, they have a much higher PE ratio. Well, what does that mean? That means investors are willing to pay more for a share of stock for every dollar they earn in profits. Why would they want to pay such a higher rate than what an average is for the market? Normally because they feel as though the earnings are going to rise. The company is going to be more profitable soon, and thus the price of the stock should be higher. And so That's how it works. But PE ratios can also be a warning sign if the future profitability is not very good. So here you have Skechers with the 34 price earnings ratio, which means investors are willing to pay $34 for every dollar of earnings on this stock, which is very high. You know, is Skechers that much better a brand than Nike or Reebok or whatnot? Are they that hot? Are they selling really, really high, fast? It could be that the price earnings ratio is a warning that that the company might not be doing so well. They might not have the earnings to support its stock price, and thus it can be looked at as something that's overvalued. So it can go either way. It can go either way. Again, it's just a ratio, and the interpretation is up to the eye, you know, whoever's looking at it. Okay. All right, so let's go over our ratios from long ago. And I think these are going to come back to you. And like I said, you can say, oh, yeah, I remember this. First, some liquidity ratios that might ring a bell. The first couple are from Chapter 2. In Chapter 2, we learned about the current ratio and working capital, where you compare the current assets with the current liabilities. Now, for a working capital, it's simply subtracting the two numbers. So this is total current assets minus total current liabilities, and that's working capital. For the current ratio, it's in a ratio form. So current assets over current liabilities. These, again, we learned these way back in Chapter 2. If you want to look at that in your book as well, give you a little memory boost. You'll see those play out, but we've seen all of those before. You probably also notice the inventory turnover ratio is here as a liquidity ratio. Again, the liquidity ratio is getting your hands on cash so you can pay your bills, right? So current liabilities are paid with current assets. So it makes sense to compare these numbers because you pay your current liabilities with current assets. Inventory is a current asset. Inventory is something that's going to be turned into cash, right? If you have inventory, if you're a store, you want to sell it as quickly as possible. That's going to turn into cash. So it's a liquidity ratio, technically, because inventory will eventually be cash. The turnover, if you remember, this is way back in Chapter 6. Inventory turnover is about how quickly a store or a company will sell out its inventory. It's usually looked at as how many times per year they are selling out their inventory. That's the inventory turnover ratio. And we got it by looking at their cost of goods sold over their average inventory. That gave us a number of any number which shows us how many times per year they're selling out. For lower priced items, that number is relatively high. So in the book, we looked at Walmart, Target. The industry had anywhere from a 6 to 8 times turnover ratio. Very, very quickly, they're selling that out. If you have a higher price store with higher price luxury items, that inventory turnover rate may be much slower. It may not be as high as 8 times a year, maybe 2 or 3 times per year. But that doesn't necessarily make it a bad thing. It's just that's how quickly they are getting rid of their inventory and turning that into cash. Once you know what the inventory turnover ratio is, you can put that underneath 365 to find out the number of days you're keeping your inventory before it's sold off. So that was way back in Chapter 6, if you can remember that. That's where these numbers come from. We also looked at accounts receivable in Chapter 8. We're going back here, right? A little bit of a tour. But accounts receivable will be turned into cash. Matter of fact, what is accounts receivable? You've already performed the service. You've already provided the goods. You're waiting to collect the cash. That's why it's a receivable. You're waiting to receive cash. So clearly, accounts receivable is going to be turned into cash. So it's a good liquidity ratio to look at. Accounts receivable turnover is how many times per year are you collecting? So basically speaking, most companies that do business with other businesses like to collect their receivables in 30 days. So if we're assuming they're collecting every 30 days, roughly speaking, and there's roughly 30 days in every month, they should be collecting 12 times per year. Accounts receivable turnover looks at the yearly rate, how many times per year they're collecting. We would be looking at 12 times a year or more. Once you have the inventory turnover rate, particularly if it's below 12, that means they're not collecting as quickly. Over 12, they're collecting faster than that. Once we have the inventory turnover rate, we can put it underneath 365 and calculate the number of days. So notice every time you put something under 365, it's calculating the number of days. Days in inventory, days you're waiting to collect. And so that's really important to sort of know as well. You need to have the turnover rate first in order to calculate the number of days. But again, your average collection period should match your terms. If you're giving everybody 30 days to pay you, you should be collecting every 30 days or less. Okay. Solvency has to do with, long-term debt. Solvency has to do with more long-term debt. So we looked at a couple of these. Actually, we looked at all of these, believe it or not. The debt to asset ratio looks at your total liabilities to your total assets, right? That's the debt, total liabilities to asset ratio. It really looks at how reliant are you on debt to buy your assets? What percentage of your assets are bought with debt? So, and most of the time when you're buying assets, you're buying building, equipment, things, these are long-term debts. So we're looking at total liabilities to total assets. Solvency is about managing that long-term debt. Some companies have a lot of assets and they borrow money for them. Some companies don't need to borrow a lot of money for their assets. So it's gonna range based on the type of industry it is. The more industrial the industry, the more machinery they need to work, the more assets they're gonna have, and probably the more debt they're gonna have because they're gonna need to borrow money to buy that equipment and machinery. So it really depends. Really depends. As we saw in the book, if you remember, this, by the way, it was chapter 10. We're going back to chapters. This one and the next one were both a part of chapter 10. General Motors had a very, very high debt to asset ratio, that 80%, which meant 80% of their total assets were financed by debt. That's a lot of debt to have, okay, on the books. So the question is, well, do they have too much debt? Are they able to handle a large debt load? Well, one other way to find out if they can handle such a large debt load is looking at another ratio that we learned about called times interest earned. And times interest earned is basically, in brief, it's how many times does their profit cover their interest expense? Remember, if you have liabilities, you're paying interest on those liabilities. So we can look at how many times over your profit is covering your interest expense. Okay. So again, if you look back at chapter 10 and you look at General Motors example that was there in your book, you did see that they had an 80% debt to asset ratio, which is high. But you also might have noticed that they had an 11.5 times interest earned, which means that their profit basically can cover their interest expense over 11 times. Okay. So they're very capable right now of handling that type of debt. It was better than the industry. The industry was only 3 times. In other words, the automotive industry had a profit that was only 3 times greater than their interest expense. So clearly, that's not a lot of room. Another thing we looked at from last chapter, the cash flow chapter 12, was the free cash flow. Okay, free cash flow. And free cash flow was the net cash provided by operating activities minus your capital expenditures. Now, this is specific to, as you remember, property, plant, and equipment. Okay, that's the type of capital expenditures we're talking about, buying long-term fixed assets, basically. Minus your cash dividends gave you your free cash flow. That's important too, because it helps manage things in the long run. Now, notice all of these ratios so far, and why it's financial statement analysis is because all of these numbers, whether it's total liabilities or assets, you're going to look on the balance sheet. Net income, interest expense, income tax expense, you're going to look at the income statement. Cash provided by operating activities, capital expenditures, cash dividends, you're going to look at the cash flow statement. So all of these numbers come from the financial statements. So your financial statement analysis project is a very good skill to have, because then you'll need to know how to read and use your financial statements properly. And again, this comes way back from chapter 12, which we just did last week, I believe. So I'm sure you remember that. Then we have a whole slew of profitability ratios, because the owners want to make sure that the company is profitable. So there's lots and lots of ratios to tell owners the story about whether the company is very profitable or not. We've already looked at the price earnings ratio, so I'm not going to review that again. But we did see earnings per share way, way back. Again, this was also way back in chapter 2, if you remember. And the earnings per share is simply the amount of profit the company made divided by the average common shares. How much is my share of the profit? Is basically all it is. Remember, preferred dividends for 92% of companies is going to be a big fat 0. So most of the time it's just your net income divided by your average common shares outstanding. There are a few companies that still have preferred stock, so they will have preferred dividends. But for the most part, most companies will be 0 here. Okay. Another thing to look at for profitability would be things that we learned way back in chapter 5. Okay. You might remember in chapter 5, we looked at the multi-step income statement. That gave us a look at the gross profit rate, which was the gross profit compared to the net sales. That was important. And the profit margin is simply the net income over the net sales. Again, these are profitability measures because they're extremely important to owners and investors. A few more profitability ratios show up. 2, we looked at specifically in chapter 9, when we talked about property, plant, and equipment. In chapter 9, we did some analysis. 1 is the return on assets. When you have your average total assets, the purpose of assets is to generate sales and profits. Return on assets tells you whether your average total assets is generating a profit. So it's the net income divided by the average total assets. So that net income comes from the income statement, as you know. Total assets are average, so you got last year's total assets plus this year's total assets averaged together, and boom, you have your return on assets. Asset turnover is really about are your assets generating sales? The purpose of having assets, all that property, plant, and equipment, is because you want to sell the products that you are making. And so net sales compared to the same number here, over average total assets, will give you the asset turnover. You want to know if your assets are being used efficiently to sell whatever you're making. And that was all part of chapter 9. You might also remember from chapter 11 when we looked at stockholders' equity, right? We saw a couple of very interesting ratios at the end of that chapter. First was the payout ratio, right? How much of the net income are they sharing with the owners in the form of a dividend, right? So the cash dividends divided by the net income gives you that payout ratio. The net income is based on a profitability thing, but I don't consider payout ratios profitability. But your book does, it's fine. Your return on equity, this is specific to common stockholders' equity, which is on your balance sheet, right? So you need to have an average common stockholders' equity. So you're looking at last period's common stockholders' equity plus this period's common stockholders' equity divided by 2. And what are you hoping for? Is that the profit of the company provides a very good return. Again, most of the time, 92% of the time, there's no preferred dividends. So it's really about the net income or the profit of the company divided by the average equity for common stockholders. They want to see that be very, very high. So that's basically that. What the appendix gives you is and I'm going to go through this only to show you what a ratio analysis would look like for Chicago Cereal Company compared with General Mills, compared with the industry, and intercompany means compared with itself. How did it do last year compared to this year? Okay, so all of this that I'm showing you is sort of a show and tell. It's part of the appendix of this chapter that shows you what learning objective 3 was talking about. In order to do any type of financial analysis, you need financial statements. This is a comparative balance sheet showing the balance sheet numbers for at least the last 2 years in this case. You can have, and your project does have one for Apple showing 5 years. Okay, so you can do it for, in this case, the homework is simply on these 2 years, 2013 and 2014. So that's one thing you need, comparative balance sheets. You also need the income statements for the same 2 years, 2013, 2014 in this case, right? You need that. You also need the cash flow statements, okay, for both 2014 and 2013. Okay, so these are the 3, you need these statements to do ratio analysis, to do actually any financial analysis whatsoever. So again, we are going to be looking at the same ones we looked at: liquidity ratios, solvency ratios, profitability ratios. You're simply using the information from those statements to do it. So when it asks you about the current ratio, you're going to look at the current assets and the current liabilities. You're going to get those numbers from the balance sheet, right? You look for, in this case, Chicago Cereal had a horrible, they all have a horrible current ratio, 0.67 to 1. And General Mills has the same, 0.67 to 1 for 2014. What does this say? They have 0.67, 67 cents of assets for every dollar in current liabilities. Remember, this is current assets to current liabilities. 67 cents of current assets to every dollar in current liabilities. That's just horrible. That's just horrible. You want to have a healthy ratio is like 2 to 1 or close to 2 to 1 is a very healthy ratio. This is horrible, which means that they may have a hard time, grabbing enough cash to pay their bills. They might not. Remember, these ratios, current assets, is just for a day. This is a snapshot of a day, right? Because balance sheets are only done by the day. Okay, there's no period balance sheet. Right, balance sheets are day to day. There's only a date, one day on the balance sheet. unlike an income statement, which is for a period of time. So this is what happened on this particular day, in that year. So horrible, 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 but it's just that day. Accounts receivable turnover, another liquidity measure. You need your net credit sales divided by your average receivables. So you need receivables from the previous year and this year averaged together, divided your sales go on top here. So notice for Chicago Cereal, their receivable turnover was 11.9. General Mills had a turnover of 12.2, and the industry 11.2. So accounts receivable turnover, right? You want to collect your money, your receivables, every 30 days, roughly. So that means 12 times a year. So clearly General Mills is doing it perfectly the way it's supposed to be. Chicago Cereal is doing it, but it's a little slower, right, than that. The industry is not doing as well. So how does Chicago's turnover compare to General Mills? Slightly lower, slightly lower. It's high. Of course, they're doing better than the industry. 11.9 is higher than 11.2, but it's a little slower than General Mills. Clearly, General Mills is collecting their receivables a little quicker. Okay. Oops, sorry. Convert that same receivable to a collection period into days. So when you take the receivable turnover and you put it underneath underneath 365, you'll see that Chicago Cereal is collecting every 30.7 days, General Mills 29.9 days, the industry every 32, a little more than 32 and a half days. So clearly, if you have a policy of collecting your receivables are net 30, everything is due in 30 days, you want to collect in 30 days. So clearly General Mills is doing that. Chicago Cereal is doing that, but they're waiting longer. 30.7 days might be like a day late, right? The industry is waiting a couple of days to get paid, longer than they want. So again, it's a liquidity issue. Whatever the general rules it says here is the collection period should not greatly exceed what your terms are. And most terms, as you know, are net 30, right? Pay in 30 days. Inventory turnover, how quickly they are turning over their industry during a particular, inventory during a particular period of time. Cost of goods sold over average inventory. So here for Chicago Cereal, their inventory turnover was 7.5 times that year. General Mills 7.4, industry 6.7. So clearly, Chicago Cereal is on par, doing slightly better at selling off their inventory, right? Slightly better than General Mills, but they went down from 2013. They were selling their inventory faster, 7.9 times a year versus 7.5 times a year. So they went down from last year, but they're still a little better than selling their inventory than General Mills. Okay. Of course, it's much, much higher than the industry. The industry is not moving a lot of inventory, comparatively speaking. For the days in inventory, now that you know what the ratio is, put that under 365 and it turns to days. So Chicago Cereal is getting rid of its inventory roughly every 48.7 days. That's a cleaning out. That's a lot of cereal to move. General Mills, about 49.3 days. The industry is probably needs a different breakfast cereal. Maybe a little bit of Wheaties. I'm not sure, they need some strength. So how does Chicago compare to General Mills? Good. Right, they're selling out their inventory a little faster than General Mills. Okay. So solvency is about that debt that we're looking at. So the debt to asset ratio, total liabilities to total assets. For Chicago, it's 78%. So 78% of their assets are financed with debt. Okay. Compare that to just 55% to General Mills and the industry. So clearly, Chicago Cereal has a substantially higher debt to asset ratio. Okay. And from 2013, it went from 81% debt to asset to 78. So actually, it's gotten better. Okay. They still have a lot of debt, a lot of long-term debt, but it's getting better because it went from 81 down to 78%. So that's a good thing. But still, clearly, General Mills and the industry don't seem to be carrying a ton of debt on their books. Is that debt costing them, right? Yeah, of course. We have to pay interest on our debt. The times interest earned, look at how many times the profit of the company basically is able to cover the interest expense. For Chicago, it's 5.8 times. So almost 6 times greater, which is not bad. Of course, General Mills is not sweating this at all. But look at this, even though they have a higher debt to asset ratio, they're able to cover that expense a little better than the industry is. They're not sweating it as much as the average company in the industry. General Mills is not sweating at all. Okay. Free cash flow, again, we're looking at the cash flow statement. Net cash provided by operating activities minus your capital expenditures minus your dividends, cash dividends. Again, a good amount, right? From 2013 to 2014, it's still over $500,000 in free cash flow, which is great. General Mills, almost $900 million. You can't compare this to the industry. There's no standard for that. And I don't really think you can compare it between these two companies either. Okay. Now we look at some others like the return on stockholders' equity, that net income divided by the average stockholders' equity, because in most cases the preferred dividends is 0. Hey, Chicago is killing it. 48% return on common stockholders' equity. Their stockholders should be very, very happy. This is extraordinary, really, really high. And it's almost as high, it's a little higher than it was the previous year. So they're just doing something great. General Mills at 25%, that's not shabby either. I mean, anything in the double digits is good. 25% is really good. 19% is decent. But as you see, Chicago Cereal is just kicking their Cheerios all the way home. So there we go. Honey Nut Cheerios, I'm not sure. But they're doing really, really well. It's unusually high. Their return on assets, when you look at that net income to average assets, 10% versus 6% versus 5%. Again, here, Chicago Cereal is kicking it. They are really using their assets very, very well because it's generating a significant amount of profit. Okay. Their profit margin, which is their net income compared to the net sales, 9.4% of every dollar is kept as profit, compared to 8.2% for General Mills, compared to 6.1% for the industry. So again, highly profitable. For every dollar they're selling, they're keeping more than 9 cents. That's outstanding as a profit. Okay. Asset turnover, are they using their assets well? Well, let's compare the net sales to the total average assets. Chicago Cereal is outstanding. Outstanding. This 1.07 means in general, for every dollar in total assets, they're generating $1.07 in sales. So way, this is phenomenal. General Mills, that's not too bad. It could be better. 7 to 6 is basically they're generating about 76 cents in sales for every dollar in average total assets. The industry is doing better than General Mills. But Chicago cereal is, I don't know, pour some milk on it. This is done. Gross profit rate, gross profit to net sales, very high gross profit rate for Chicago cereal, 44%, same as it was the previous year. Slightly lower gross profit rate for General Mills, but still both of them are much higher than the industry. So that's very good for both companies. Earnings per share is not something that really can be compared company to company. It has to be compared within the company from one year to the other. That's the best way to do an earnings per share. And if you do it that way, you can see that Chicago cereal was more profitable in 2014 than 2013 because their earnings per share went from $2.40 per share of ownership to $2.63 per share of ownership. So each share of ownership got a bigger part of the profits, and that's how you measure whether it's good or not. I can't tell whether that's okay for General Mills. And you certainly can't compare General Mills to Chicago. Can't compare a $1 billion company to a smaller $1 million company. You just can't. Not in this way. Price to earnings ratio, the market price of the stock compared to that earnings per share we just looked at. For Chicago, it's at a 20 times earnings, which within range. General Mills at 24, also within the normal range. Normal range for S&P big companies between 15 and 25 is relatively normal. The industry higher than that. So one of two things: either the cereal is going to be popping and more profits are ahead, or a lot of companies in this industry at this time had high stock prices but no profits to back it up. So they were overvalued. Payout ratio, how much of their net income are they sharing as a cash dividend? Chicago at 43%. General Mills at 54%, the industry 37%. You don't really want to see this really, really high because it's just not sustainable. The fact that General Mills is giving away more than half of their profit to their stockholders makes you wonder, well, are they investing in anything new? And some companies even give out more than that. They give out 60, 70, 80% of their profits to the stockholders. Like, what are they doing? They're just waiting to die and they're just sharing the money, because you have to reinvest your profit into new and better ways of doing business. And clearly you can't do that if you're giving too much of it away. But for some companies like food, it's a more stable business. So you can probably afford to give out a little bit more. So 40% is not bad. Not bad. It's a little high for a lot of companies, but it's not bad. So that's what it would look like in total. You're using those financial statements, finding the numbers you need, plugging it into the ratios accordingly, and doing the calculation. You're going to practice that this week. The homework will be for both the vertical horizontal analysis and this ratio analysis, which you see is a little bit more detailed, a lot more things to look at. That's going to be open all and due next Thursday night. We'll meet next Thursday night to see how that went. Okay, and if there was any leftover questions. In the meantime, your final project will be opened. It'll be open even after this class. It'll be opened all the way through May 4th. You don't have to do it until you're done with this homework. But some of you might go through the analysis and feel like, piece of cake, I get it, no big deal. And I didn't want to stop anyone who had the time and energy, who wanted to do their final project, from doing it early. But it's not required. I'll review everything next Thursday in brief. It shouldn't be a very long meeting next week. Just to check in, see how you're doing. If there was any leftover questions, we can review anything. And then all you have left is that final project, which is a lot of financial analysis. But this is a skill worth having. Look how far you've come from, income statement, what's that? Balance sheet, what's that? To now we're analyzing all that stuff. Really good stuff to do, really good stuff to know. And a good skill to have. It's one of my favorite things to do. How we doing? Questions?